Let me start with a very simple truth. You don't need to own 100 stocks to become wealthy. In fact, sometimes just one idea, one decision can completely transform your life. There was a man, ordinary like you and me, who became a billionaire not by chasing every hot trend, not by trading every week, but by identifying one company, one stock, and having the conviction to hold it. Now, most people think this kind of success is luck. They'll say, oh, he was just at the right place at the right time. But that's not the truth. The truth is he understood something most investors never do. Wealth is created not by constant activity, but by patience, by focus, and by aligning yourself with a great business for the long haul. So if you give me your attention for the next few minutes, I'm going to walk you through how one stock, one decision turned into billions. And more importantly, what lessons you can take away, because the next big opportunity could very well be in front of you today. When you look at the story of someone who became a billionaire from a single stock, the first instinct is disbelief. People say, that can't be possible. Surely he had dozens of bets, hundreds of irons in the fire, and one of them just happened to hit. But that's not the reality. The reality is far more interesting and far more educational. The truth is, he had the vision to focus on one powerful idea when the rest of the world was distracted by noise. That is the power of conviction. That is the power of belief in a single idea. Most people in markets behave like tourists. They show up for a short while, they look around, they want to collect a few experiences, and then they move on to the next shiny thing. They buy a stock this week, sell it next week, buy another one because some analyst on television says it's hot, and then panic when it drops. They confuse activity with progress. But wealth isn't built that way. Wealth is built by finding a business you understand, a business you can predict, and a business you are willing to marry for the long term. Think about it this way. If you were to put all of your family's wealth, all of your children's future into one investment, how deeply would you study it? You would read everything. You would understand the industry, the competitors, the risks, the management, the culture, the moat. You would not care about what the market does tomorrow or next month. You would only care if 10 or 20 years from now, this company still dominates, still grows, and still creates value. That is exactly what happened with this man. He saw a company not as a ticker symbol bouncing on a screen, but as a living organism with a future. And the world laughed at him. Friends told him he was reckless. Advisors told him he needed diversification. Every magazine screamed about the next big thing, and he ignored all of them. He ignored them not because he was stubborn, but because he had clarity. He had studied enough to know that this was not a gamble. It was a calculated alignment of his capital with a business that had the potential to change everything. And history proved him right. You see, vision is not about predicting the next quarter's earnings. Vision is about seeing where the world is going and which companies will lead it there. He saw consumer behavior before it was obvious. He saw technology shifts before they were mainstream. He saw leadership that others underestimated. And he believed. Belief is underrated in investing. Without belief, you cannot hold when markets test you. Without belief, you will sell at the first storm. But with belief, rational, informed, disciplined belief, you can stay the course when everyone else abandons ship. Now, why is this important? Because every single one of us is surrounded by opportunities like this. Maybe not every day, but certainly in every decade, the world keeps producing transformative companies. Some will revolutionize technology. Some will revolutionize how we eat, how we travel, how we consume information. The question is, do we have the vision and the courage to bet on them when they are small, when they are misunderstood, when they are ignored? Or will we always be chasing what is already popular, already expensive, already crowded? This is the essence of wealth creation. The market pays those who can see differently. If you see what everyone else sees, you will get what everyone else gets, average results. But if you are willing to think independently, study deeply, and act with conviction, then the rewards are extraordinary. One stock, one idea, one vision can literally change everything. But let me be clear, it is not about blind faith. It is not about gambling on a hunch or a rumor. It is about building conviction through knowledge. This man didn't just throw a dart. He spent countless hours studying. He knew the numbers. He knew the competitive advantages. He knew the leadership. And most importantly, he knew himself. He knew he had the temperament to hold, to wait, and to ignore the noise. That temperament is as important as the idea itself. Because what happens when the stock falls 30%? What happens when the media says the company is finished? What happens when your neighbor says you're crazy for holding on? Most people fold. They cannot take the pressure. But he held. He held because his vision was not based on price fluctuations. His vision was based on the fundamentals of the business. And that's why one stock turned into a fortune. When you hear this, the temptation is to think, well, he was special. He had some magical gift, but that is not true. He was not special. He was disciplined. He was patient. He was focused. Those are qualities anyone can cultivate. The difference is that very few people want to. Most want shortcuts. Most want constant excitement. But investing, real wealth building investing is not about excitement. It's about endurance. It's about clarity. And so the lesson here is simple. You don't need 100 good ideas in life. You only need one or two great ones. But when they come, you must recognize them. You must trust them. And you must be willing to stay with them long enough for compounding to work its magic. Because when compounding works over decades, the numbers stop making sense. They become unimaginable. That is the silent miracle of wealth creation. And it all begins with the courage to back a single vision. And that is exactly how one man, through one stock, turned a simple decision into $1 billion fortune. When people hear that someone held a single stock long enough to become a billionaire, they underestimate what that really means. They imagine it as a smooth upward climb, as if the stock just rose in a straight line from obscurity to greatness. But markets don't move like that. Businesses don't grow like that. The reality is far messier. There are setbacks, crashes, doubts, endless criticism, and sometimes years of stagnation. And this is where most people fail. They cannot endure the waiting. They cannot resist the urge to act. They think wealth is built by doing more, by trading more, by reacting faster. In truth, it's the exact opposite. Wealth is built by patience, by staying still when everyone else is running in circles, by holding on when panic is the default. The man who became a billionaire on one stock didn't do it by avoiding pain. He lived through every crash, every bear market, every moment of fear. There were times when the stock lost half its value, times when news headlines declared the company dead, times when investors abandoned it in droves, and yet he did not sell, not because he was blind or stubborn, but because he understood the difference between price and value. Price is what you pay, value is what you get. Price moves up and down like a heartbeat, but value, if the business is truly great, keeps growing over the long run. Patience in investing is not passive. It is one of the hardest disciplines you can practice. Imagine watching your net worth shrink on paper, sometimes by millions or even billions, and doing nothing. That goes against human nature. Our instinct is to protect, to react, to flee from pain. But he did not. He understood that panic is the destroyer of compounding. He understood that time in the market, not timing the market, is the true engine of wealth. And he trusted the compounding process. It's very easy to say buy and hold when the market is rising. Everyone is a long-term investor in good times. But the true test of patience comes when the storms arrive. And storms always arrive. It could be a recession, a regulatory shock, a technological shift, or just fear running wild. Every decade delivers multiple reasons to sell. And yet those who held through all the noise are the ones who come out on the other side with unimaginable wealth. That's the irony. The reward is not for brilliance, but for endurance. Think about the great fortunes of our time. Again and again, you see the same pattern. A company grows steadily for decades, compounding earnings year after year, while its stock price dances up and down in the short term. Those who sold during the downturns locked in mediocrity. Those who held through them participated in greatness. Patience was the only real difference. This man's patience was not laziness. It was a form of conviction. He had done the work up front, so he didn't need to constantly second guess himself. When prices fell, he didn't ask, should I sell? He asked, has the business changed? If the business was still strong, if the leadership was still competent, if the moat was still intact, then nothing had changed except sentiment. And sentiment is the least reliable guide in investing. The market in the short run is like a voting machine driven by popularity, by fear, by fashion. But in the long run, it is a weighing machine. It measures substance, performance, and results. He understood this distinction better than most. That's why he could sit still for years, sometimes a decade, without flinching. He knew time was working in his favor. Every year that passed, the business he owned became more valuable, And eventually, the stock price had no choice but to reflect that reality. There is another lesson in his patience, the power of inactivity. In most fields of life, doing more leads to better results. If you train more, you get stronger. If you study more, you get smarter. But investing is one of the very few fields where doing less often leads to better outcomes. Every trade costs money. Every trade creates the possibility of error. Every trade interrupts the magic of compounding. By not acting, by sitting still, he eliminated friction and gave compounding the cleanest runway to work. That is why his returns look extraordinary, not because he found constant new opportunities, but because he allowed one opportunity to blossom fully. It's worth asking how many people have missed out on generational wealth simply because they sold too soon. They saw a 2x gain, a 5x gain, maybe even a 10x gain, and they thought they were smart to lock it in. But had they held, it might have been a 100x or 1,000x. The difference between the two outcomes is not intelligence. It is patience. Selling too early is the silent killer of wealth. And let's not forget, patience isn't just about waiting. It's about enduring ridicule. Imagine holding a stock for years while others mock you for not taking profits. Imagine holding when analysts downgrade it, when experts predict doom, when the financial press calls it overvalued. That requires thick skin. That requires faith in your process. He had that. And that is why, while others cycled through fads and trends, he simply stayed put, and compounding rewarded him for it. So the second great truth in this story is simple patience is more powerful than prediction. If you can hold through the storms, if you can resist the panic, if you can trust the process, then time itself becomes your ally. And when time is your ally, wealth creation is inevitable. And that is why patience, not panic, turned one stock into a billion-dollar fortune. When people hear the story of someone becoming a billionaire from a single stock, it's easy to assume it was just luck, a lottery ticket that happened to pay off. But that narrative is too shallow. Luck might give you a small win here or there, but it rarely produces a fortune that endures across decades. What really made the difference was not luck, but calculated risk. It was the ability to look at a business, strip away the noise, and decide with clarity that this was worth betting on. And once that decision was made, it was not guesswork. It was conviction grounded in facts. Most investors confuse risk with volatility. They see a stock price jump up and down and call that risk, but that's not risk. Risk is the possibility of permanent loss of capital. Volatility is just the ride you take to get there. This man understood that distinction clearly. When the stock moved up or down in the short run, he didn't see danger, he saw noise. He was focused on whether the underlying business was growing, whether customers were loyal, whether the moat was widening. And because he looked at risk through the lens of fundamentals, he could sit calmly while others ran away. Calculated risk means doing the homework. It means looking at the numbers with brutal honesty, not with wishful thinking. It means understanding the competitive landscape, the regulatory risks, the possible disruptions. It means asking the hard question, if I put my money here, what is the chance that this business disappears in 10 years? If the answer is low, and if the upside is massive, then that is not gambling. That is intelligent risk taking. That's exactly what he did. He didn't throw a dart at a board. He dissected the opportunity, understood the odds, and then acted decisively. There's another layer here that people often miss. The courage to act when an idea is unpopular. By definition, the most rewarding investments are the ones that others haven't recognized yet. That means when you step in, you will often feel lonely. Analysts won't agree with you. The crowd won't agree with you. The narrative will say you're wrong. And yet, that is when the risk-reward equation is at its most favorable. He had the courage to place a concentrated bet when the world was looking elsewhere. That was not recklessness. It was discipline in the face of disagreement. Calculated risk also means knowing yourself, not just the business, but your own psychology. Most people can't stomach large declines, even if they know intellectually that the business is fine. They sell because the pain is too great. He knew his own temperament. He knew he had the ability to endure volatility without flinching. That self-awareness was part of his calculation. He didn't just ask, is this a good business? He asked, can I personally hold this through the storms? And because he answered yes, he positioned himself to reap the rewards that few others could. Let's be honest, every investment has uncertainty. The future is never fully clear, but the key is to tilt the odds in your favor. He stacked the deck. He looked for asymmetry, for situations where the downside was limited, but the upside was extraordinary. That's the essence of calculated risk. If you can consistently place bets where you risk losing one, but stand to make 10, you don't need to be right all the time. You just need to be right once or twice in a lifetime. And this was one of those times. What separates this from gambling is process. A gambler plays odds he doesn't control. He rolls dice and hopes. An intelligent investor creates his own odds. He studies the moat. He studies the management. He studies the balance sheet. And after all that, he doesn't bet because of hope. He bets because of conviction. He knew the probabilities and he knew they were in his favor. That's why he could stay with the decision for years, because it wasn't built on speculation. It was built on reason. It's also important to recognize what he didn't do. He didn't spread his money thin across 20 different ideas, hoping that one of them might work. That's not conviction. That's hedging ignorance. He put meaningful capital behind one idea because he knew it deeply. Concentration, when paired with knowledge, is not risky. In fact, it is safer than holding a basket of half understood bets. The real risk lies in shallow thinking. He avoided that trap by choosing depth over breadth. Over time, the market validated his decision. What began as an idea most people doubted slowly became obvious to everyone. The company grew quarter after quarter, year after year, and eventually the stock reflected that growth. People called him lucky. But it wasn't luck, it was clarity plus courage. He saw what others didn't, he acted when others wouldn't, and he stayed when others couldn't. That's the essence of calculated risk. There's a lesson in this for all of us. The path to extraordinary wealth doesn't come from avoiding risk altogether. It comes from embracing intelligent risk when the odds are tilted in your favor. It comes from putting yourself in a position where even if you're wrong, you survive, but if you're right, you thrive beyond imagination. Most people never do this. They chase trends, they listen to noise, they diversify into mediocrity. But the great fortunes are built by those who dare to be bold when the analysis tells them the reward far outweighs the risk. And that is why, in his story, it wasn't luck that made him a billionaire. It was the discipline of taking calculated risk, the clarity to recognize the opportunity, and the courage to act when very few others did. When we talk about one stock creating a billionaire, it's easy to stop at the money. People focus on the dollar signs, the headlines, the net worth rankings. But wealth, real wealth, goes beyond numbers on a balance sheet. It creates freedom. It creates choices. It creates influence. And sometimes it creates a legacy that stretches far beyond the individual who earned it. That is the part of the story that often gets overlooked, the impact that extends well past the money itself. When this man became a billionaire from one stock, he didn't just buy luxury cars or mansions. Although he could have had as many as he wanted, what he really gained was time. Time to spend on things that mattered to him. Time to focus on building, on giving, on mentoring, on shaping a future not defined by survival, but by contribution. Because once you have enough money, the pursuit of more money becomes empty. The real question becomes, what do you do with it? And in his case, the answer was powerful. He used his wealth to amplify his voice. Suddenly, people listened. A person with resources, with a track record, with visible success, society pays attention. That gave him the platform to share his philosophy, his principles, and his lessons. People who might have ignored him before leaned in, curious about how he thought, how he acted, what he saw that others missed. His wealth gave him credibility, but his ideas gave him influence. Together, that created a legacy that continues to inspire. But it wasn't just about influence. Wealth also allowed him to protect what mattered to him. He could fund causes that aligned with his values. He could create opportunities for others. He could ensure that his children and grandchildren had not just comfort, but the mindset and the resources to carry forward his vision. Money became a tool, not an end, a tool to extend his impact beyond his own lifetime. And this is the part of wealth creation that too few people think about. They get caught in the race, chasing numbers, and forget that the numbers are just fuel for something bigger. There is something deeply powerful about the fact that one decision, one act of conviction can ripple across generations. The wealth he created didn't just change his life, it reshaped the trajectory of his family, and in some ways, it even reshaped the industry he invested in. That's the multiplier effect of legacy. When you make the right decision at the right time, the consequences compound in ways you can't fully imagine. Just as money compounds, impact compounds. And the irony is that this legacy came not from chasing legacy, but from focusing on a single sound decision. He wasn't thinking about monuments or accolades. He was thinking about one company, one stock, one opportunity that he deeply believed in. That's the beauty of this story. Legacies are often born from focus, not from grand plans. You focus on one thing with excellence, and over time, the impact takes care of itself. Another element of his legacy is psychological. By living this story, by proving that it is possible to change everything through patience, conviction, and discipline, he created a model for others to follow. For every young investor who doubts whether focus and long-term thinking still work, his story is proof. For every entrepreneur who wonders whether persistence pays off, his story is proof. And proof is powerful. It inspires people to try, to believe, to take their own version of the calculated risks that he once took. And think about what that means in practical terms. Even if only a handful of people learn from his example, that can lead to hundreds, maybe thousands of new ventures, new investments, new stories of transformation. His one act doesn't just echo in his own account statement. It echoes in the behavior of countless others who watched, learned, and were changed by it. That ripple effect is the true measure of a legacy. So when we talk about wealth, we should never stop at the dollar amount. Money can buy comfort, yes, but more importantly, it can buy freedom. Freedom to choose your path. Freedom to say no to things that don't matter. Freedom to dedicate your life to something meaningful. And beyond freedom, it can buy impact, the ability to change lives, to shape communities, to leave behind something that endures. In the end, the lesson of this story is not just about how one stock made a man rich. It's about how one stock gave him the platform to live life on his own terms and to leave behind a mark that others could build on. That is the real gift of wealth. That is the true measure of success. Money fades, headlines fade, but the ideas, the examples, the influence, those remain. And that is why one decision, one stock became not just a fortune, but a legacy.